If you are planning to buy a home, stay with this video until the end, because the last tip can save you a surprising amount of money over the life of your mortgage. Getting the best mortgage rate is not just about finding a lender with a catchy ad or a low headline number. It is about presenting yourself as a low-risk borrower and knowing how lenders actually decide what rate to offer you. In the United States, even a small difference in your mortgage rate can change your monthly payment, your total interest, and your long-term financial flexibility. So let's break down 5 practical tips that can help you get a better deal. Tip number 1 is to improve your credit before you apply. Your credit score tells lenders how reliable you are with borrowed money, and a stronger score usually means a better rate. If possible, pay down credit card balances, make every payment on time, and avoid opening new accounts right before applying for a mortgage. Even a modest improvement in your score can make a noticeable difference in the rate you are offered. Tip number 2 is to reduce your debt-to-income ratio. Lenders want to know how much of your monthly income is already committed to debt payments. If too much of your income is going toward car loans, credit cards, or other obligations, the lender may see you as a bigger risk. Paying down debt before you apply can strengthen your profile and may help you qualify for better terms. This is one of those quiet moves that does not feel dramatic, but it can have a real impact. Tip number 3 is to save for a larger down payment if you can. A bigger down payment usually lowers the lender's risk because you are borrowing less relative to the home's value. That can lead to a better rate and may also help you avoid extra costs like private mortgage insurance in some cases. You do not always need a massive down payment, but the more you can put down responsibly, the better your overall position may be. Tip number 4 is to shop around and compare offers from multiple lenders. This is one of the most important things first-time buyers and experienced buyers alike often forget to do. Mortgage rates can vary from one lender to another, even when your financial profile stays the same. That means the first offer you receive is not automatically the best offer available. Comparing several quotes can help you see who is giving you the strongest combination of rate, fees, and loan terms. Do not focus only on the interest rate itself, because closing costs and lender fees also matter. A slightly lower rate can be less attractive if the lender charges much higher fees to get it. Tip number 5 is to lock in your rate at the right time. Mortgage rates can move quickly, especially when inflation data, job reports, or Federal Reserve comments shake the market. If you already found a rate that fits your budget and your timeline, a rate lock may protect you from a sudden increase before closing. This matters because waiting for a perfect rate can backfire if the market moves against you. The key is to balance timing with certainty, so you do not lose a good opportunity while chasing a better one that may never appear. Now here is the bigger picture. The best mortgage rate is not just about one trick or one lucky day. It is usually the result of preparation, timing, and comparison. If your credit is strong, your debt is manageable, your down payment is solid, and you take the time to compare lenders, you put yourself in a much better position. That is how smart borrowers save money without taking unnecessary risks. Also remember that a mortgage is not just a number on paper. It is a long-term commitment that affects your monthly life for years, sometimes decades. That is why the effort you put in now can pay off many times over later. So if you want the best mortgage rate, focus on these 5 steps. Improve your credit, lower your debt, save a stronger down payment, compare multiple lenders, and lock in your rate wisely. If you watched until the end, you now understand that getting a great mortgage rate is less about luck and more about showing lenders that you are the kind of borrower they want to compete for.